We will start with the good news, and there is a lot of it. Yet another week of market highs, bulls cheering, everyone get more enthusiastic about the stock market. President Trump is again bragging about the performance, and certainly since Election Day, by midweek, almost 20% from Election Day. And if you're pro-President Trump, you can congratulate him about that. But also worth noting that, in fact, Obama's last election, it was up also 20% from Election Day through this period. So lots for both sides to take credit for. But moving to the bad news, as we have talked about many times on the bottom line, prices are hitting almost record levels. Prices relative to fundamentals like earnings and cash flow. And the problem is that over the long term, at least historically, price has been a good indicator of long-term future performance. Specifically, when prices are low, long-term performance is high, and when prices are high, long-term performance is very low. This is something that John Hussman, many others have talked about, and we've talked about on the show. The other problem right now is it's not just stocks that are expensive. It is also bonds and cash. So the usual cure for an expensive stock market, which is diversification, may not actually help you out that much if you're investing for the long term. In fact, John Hussman this week, a portfolio manager, looks at the average that you can expect from a portfolio, stocks, bonds, and cash, and it is at one of its lowest levels ever. The good news is we will end on good news, which is it's still positive over 12 years. Hussman estimates that you'll have a return of about 1% per year over the period, a far cry from the 6 to 7% of a diversified portfolio from normal valuations, but still positive, so it could be worse.
And that's nominal 1%.
Absolutely.
Right? So
My
it's
goodness.
Barely positive.
We're doing great. Yeah.
Yeah. But I mean, I do think that there are things about this, and I know last week I was a little more bullish than you, but I think that there's a lot of this that makes me nervous, the desperation for yield across all asset classes and raising everything up. So that scares me a little bit.
Yes, and this is a big difference from prior bubbles. In 2000, for example, stocks were extraordinarily expensive, but bonds were yielding 6%. Of course, at that point, everyone said, 6%? That's pathetic. I want to own stocks that go up 20% a year. But now you'd look at that 6% and you'd say, well, I want to own some bonds. That's great. But here we are, bonds yielding 0.5%, 2%. Not much solace there, so everyone is, as you say, chasing yield.
Yeah, and even the housing market is looking expensive again, or at least above the long-term average compared to rents. And even the private market money's moving there, and of course, Bitcoin and the cryptocurrencies. So it is a little concerning.
Yes, so unless you think it's different this time, which you're welcome to your opinion, if so, we are headed for a long-term period where financial assets will disappoint.